Welcome back to Business Week here on Arise News. The turbulence of 2022 continues to linger, with more companies conducting mass layoffs and investors showing more restraint in committing capital to startups and other high-growth companies globally. While African companies defied global trends, especially startups, last year and managed an 8% increase in total funds raised, the continent may not be so lucky in 2023. Well, that's according to a funding report by Disrupt Africa, which says at approximately $650 million, African tech startups, for instance, have raised less than half of the total raise in the first quarter of 2022, with only 87 startups having successfully raised in the period compared to 175 in the previous year. It is also poignant to note that half of the amount raised last year was recorded in the first quarter of the year, signaling that 2023 is headed on a fundraising regression should this trend continue. It's therefore important to understand what investors are looking out for in these companies and how founders should pitch to would-be investors. But venture capitalists are not the only players in this market. Proprietary investment companies like VFD Group, with over $300 million of investments through debt and equity and other financial products, have taken positions across key sectors in Nigeria with a growing diversified portfolio. Joining the discussion now are two specialists whose field of experience cut across both venture capital and proprietary investing. Adenubi is the executive director at VFD Group, who I referenced earlier, and VFD is an industry-agnostic proprietary investment company with a portfolio of over 40 businesses across different sectors. And also connecting virtually from Nairobi is Yomi Carr, principal of Flourish Ventures, who are an early-stage investor and have been for over a decade backing mission-driven entrepreneurs and influencers in the financial system. Thank you both for joining me on the show. I'm going to start with you, Yomi, there in Nairobi. I know Nairobi is quite a big hub for investments. Besides macroeconomic conditions, are there other factors that have influenced the decline in venture capital investing?
Yeah, and thank you for having me. I think it's important to take a look at what are the macro conditions that are affecting the existing markets and what other factors are folks worrying about. I think for one, all the uncertainty that the macro conditions have brought less certainty to the venture space. As interest rates rise in other markets, capital allocators are moving their capital from the venture asset class to less risky asset classes. Additionally, as we see across Africa in particular, there's been very few exits. And so as a venture capital investor, you are going to invest only to achieve certain returns when your businesses exit. And we saw from, as the venture ecosystem is relatively new, we've seen very few exits. We've seen only one or two IPOs, and we've only seen a few large-scale acquisitions, such as Paystack in Nigeria. In the last year or two, we've seen very few exits globally as the public markets have hit a downturn. And so all of the investments that venture capitalists have made from 2015 to 2018 that would be seeking an exit today are seeing very rocky territory. It's going to be hard for them to return capital. And so I think that's another factor that's affecting how people are allocating capital to VC.
Yeah, thank you. You make a very interesting point about the potential exit. And I wanted to ask you, Niyi, you have a different investment horizon to your traditional VC, your proprietary investment company. But what sectors do you think investors are increasingly having an appetite for in a tight credit market like this?
So I think fintech is still probably the most exciting. I think we're seeing it overplayed a little bit. I think we're seeing a lot of richness in the valuation. But I think fintech is still probably where it's most exciting. We're seeing some money come into education technology, edtech. We're seeing some money come into health tech as well. But we do believe that in payments, financial services, loans, retail businesses, e-commerce, some of the areas where we still think there's a lot of excitement.
Yeah, and clearly most of these industries are tech-enabled. So is it fair to say if you're an entrepreneur today and you don't have a business model that is tech-driven, you're not likely to attract investment?
Absolutely, I would agree with that. I think it's very, very difficult to scale without technology, and nobody wants to really put money in the businesses that cannot scale.
Yeah, okay, interesting. So, I have to ask you, this fundraising decline, we've heard from Niyi how some sectors are very attractive and these have to be tech-enabled. But what are the real implications of this fundraising decline? We saw the stats there from Disrupt Africa. What are your thoughts on what this will mean for businesses? Is it just really about the inability to scale?
Yeah, I think it's a gift and a curse. I think on the one hand, it'll be very challenging to raise capital if you have a model that doesn't have a path to profitability and a path to exit. On the other hand, the entrepreneurs who are able to develop these businesses and develop a business with a profile that investors see a true exit and see not just an emphasis on growth, but on sustainability, they will be able to raise capital. I think despite the fact that the total amount of capital is going down,
Okay, so I think we lost Fayomi there for a second, but Niyi, I think we can continue the conversation. So I wanted to understand your risk appetite because it's nice to hear about tech-enabled businesses and the amount of money you spend. But what is your risk appetite really like for an investor, a proprietary investment company?
Yes, it's a good question. So unlike most VC funds or PE funds, we don't have to return money after like 7 years or 5 years. Or 10 years.
So when do you actually have to return money, if
Through
ever?
dividends. Exactly.
Through dividends,
yes,
yeah.
It's permanent capital, right?
Yeah.
So we're a publicly listed company, we're PLC. In fact, we're about to list on the main board of the stock exchange, NGX. We don't have that pressure. So our risk is, I'd say like average, you know. We're not very aggressive, but we can take a look as longer than 5 years or 7 years. We can invest in businesses that take longer to mature because we don't have a risk of selling or listing and stuff like that. Yeah.
And so would you then argue that that model is maybe better suited to a market like this where, I mean, the business environment itself is a risk and there's so many issues that entrepreneurs are dealing with. So you're almost like patient capital.
Exactly. Actually, the reason why we decided not to go the typical route is because we feel exactly the same way. The normal VC/PE model might not be fit for this market as of yet. We don't have exits. He was just saying there are no potential buyers.
Not a very liquid stock market.
Not a very liquid exit market. Secondary market for your investments. Like he said, only Paystack I think has done a major exits in the boom years of this tech that we've seen. So it's a very, very difficult thing to balance. So that's why we went with this approach.
Yeah, indeed. So Fayomi, I understand you're back. I was just asking Niyi about his risk appetite and the fact that his investment model mirrors patient capital because of the issues you highlighted earlier. I think the question I would want to ask you is, what do investors want from African tech startups? What is the ideal company or entrepreneurial model or business model for a VC investor?
Yeah, I mean, if you look at the VC space in general, it's the highest risk asset class. And so in order for investors to be excited about making investments in a very risky asset class in Africa, which is considered a risky geography as well, it has to have the potential for a very high return. And so we're looking for businesses that can scale, that have a model that can reach a lot of consumers or businesses and that can return capital. And I think that's why, as you highlighted, the fintech sector has been so successful because in some ways, Africa's financial sectors are underdeveloped relative to the rest of the world. There's lots of opportunity to scale. That's why 6 of the 7 unicorns in Africa have been in fintech, because in payments and credit, there's lots of opportunity. So that's what investors look for. Can you scale? Can you reach these high return profile in 5 to 7 years?
Yeah, and many people refer often to high returns. Can you quantify that a bit? On average, what does a typical VC fund operating in African fintech, for instance, what should that VC fund be returning to investors on average, if you're able to?
Yeah, I don't want to be super specific because there's a range depending on the profile of the fund. But if you look at the public markets, right, in public equities, you might expect to get somewhere between 6 to 10% per year. In private equity, maybe 12 to 15. And so in VC, because of the risk profile, you're looking at 15% plus. And if you look at Silicon Valley, only the top quartile of venture investment funds actually hit that over a certain time period. And so you're expecting a return that's double the public market's return profile, which is 15 to 20%, which is actually quite challenging, which is why you take some of these riskier bets. So they might pay off and you'll see in any portfolio of 10 investments, half of those will probably fail. And one of them will be 10 to 20x that will return your entire portfolio. So you look for those individual entrepreneurs and businesses that can give you that 10 plus X of returns.
Okay, very interesting. So, Niyi, there are lots of factors impacting the viability of investments and the success of entrepreneurs. And many entrepreneurs in this market here in Niger often point to the business environment and the regulatory hurdles. But about almost a year ago now, the Nigerian government passed the Startup Act. What role do you see that type of legislation perhaps playing in helping to make the environment more conducive for entrepreneurs?
I think it's a great progress for the country and for the business community. I think we've been pushing for this for a very long time. I think it was a bit painful that it came later towards the administration, but I do think it's going to be a very positive move going forward for.
Yeah, and I guess because of your investment model, you're not just putting capital, you're probably providing some technical capacity and support.
Yes.
So how are you, what are some of the issues they're dealing with on a day-to-day basis?
So one of the supports that we like to do is what we call government relations and regulatory engagement. So a lot of the startup companies, a lot of founders are young. Sometimes they're trying to disrupt an entire industry, including the regulatory part of it. So there's not a lot of engagement with that side. So when we come in, we try to do some hand-holding there because this is very important. Then governance is also very important. I think one of the issues that the government or the regulators usually have has to do with governance, transparency and stuff like that. And we try to bring in world-class governance structures into the companies that we invest in.
Yeah, and I want to ask both you and Efayomi this question before you go on break. I'll start with you, Niyi, very briefly. When you hear a pitch from a company, what is it that excites you the most, that gives you that intuition that, you know what, this seems like a good investment? First impressions.
It's the energy of the founders. If it's more than one founder, the chemistry between them, but it's typically the energy of the founders. Then their vision is important. Because most times when you look at most companies, the original idea they come up with isn't the idea that becomes successful. So it's not really about what they say they're doing at that time. But you know that if they keep that energy, that passion, that chemistry together, they will always find a way to break through.
Very interesting point. So, Efayomi, people often say that investors are investing in the founder initially, not the business. What are your thoughts? And what is more important, the pitch, the leadership, or the business model?
Yeah, I would say depending on the stage, it might be slightly different. At the earlier stages, it's very much dependent on the leadership. As Niyi said, the model itself can change over time. But at the later stage, you want to have confidence in the business model, that this can make money, that this can scale, that this is in the right market. I'd say at the stage where I invest, which is seed, Series A, we look for, I think Niyi mentioned this, the vision of the founder. There's a unique quality of founders have where they have an attention to detail, so a very strong ownership of the particulars of their business, but also they can take a step back and have a vision to articulate where they're going and what the opportunity is. When I see that in a founder, they really know their stuff, but they also understand where the market's heading. That's really a strong quality to invest behind.
Yeah, very, very interesting. And I guess between both of you, Nigeria is a big hub for tech founders. Nairobi actually has quite the pedigree. I guess that's why you're there. I know you have a Nigerian background, but you're based in Nairobi. So which markets are really exciting from an investment perspective? I know Niyi is mostly investing locally, but do you have some thoughts, Niyi, as to what markets?
Yes, we do like Nigeria a lot. I mean, everything speaks well for Nigeria apart from the economic growth. We're looking at Ghana, we like Rwanda, we like East African Hub. Those are the key places that we're looking at.
Okay, great. Efayomi, what about you? I guess you have a bias towards Nairobi.
When you take a step back, there's 4 markets that account for 85% of venture investment, and that's Kenya, Nigeria, Egypt, and South Africa. All of those markets have a bit of a nuance, but Nigeria's had the most successful, at least from the tech startup perspective, huge addressable market, highest GDP, and so that really does incentivize a lot of success. And so we focus on those 4 markets, but we've had our most success overall in Nigeria.
Okay, great stuff. So we'll take a short break now, and when we return, we continue the discussion on private investing and venture capital. Stay tuned. Welcome back to Business Week here on Arise News. I've been talking to Efayomi Carr in Nairobi and Niyi Adenubi here in Lagos on VC and private investing. So we talked about the regulatory landscape, delved a bit into some of the returns, but I wanted to understand from both of you, and Efayomi, I'll start with you, how easy is it to raise funds in this market as a venture capitalist?
Yeah, as a venture capitalist or as an entrepreneur?
Well, as a venture capitalist, so from the fund perspective, presumably you have other investors investing in your funds? So your limited partners, for instance.
Yeah, absolutely. So I would say there's three categories of limited partners. I would say one are folks who are purely commercial, family offices, high net worths, et cetera. The second are DFIs, IFC, FMO, these large government organizations. And the third are strategics, folks like MasterCard and Visa, et cetera. I'd say, depending on what type of fund you are, that will dictate the appetite for different types of LPs. I'd say the first category of purely commercial capital, it's becoming very challenging. As I mentioned earlier, as interest rates increase and other opportunities emerge, smart money will move their capital from venture into other asset classes that might be less risky and have a higher return profile. For the other two categories, they might have different incentives, so there might be still an opportunity to raise from strategics and DFIs.
Yeah, that's very interesting. And Niyi, just a similar question to you, but with a slight twist. So why would a MasterCard go through a fund rather than do its own proprietary investments? Is it just risk appetite?
And just the management of those investments. Actually.
Okay.
So we started out investing directly in companies. And it can be a bit of a problem, like we were talking about during the break. Some startups are not yet there. They require more help. So even we, in the last 2 years, have done 2 LP investments, which we're now investing through other venture capital firms because it's easier for them to manage those people.
Yeah. So I think you are doing quite a lot of power and infrastructure. Is that because we have such a low base of those infrastructure asset classes in Nigeria that you just see huge long-term opportunity? Where is your risk appetite leaning towards, more infrastructure or finance?
Well, we like finance because it's our mainstay. But we think that infrastructure, the infrastructure gap in Nigeria is just too much. If you talk to a lot of founders, a lot of business owners, they will tell you that their biggest issue probably is around power, right? A lot of times. So we think that there's a lot of room for growth in that space. We think that it's coming from a very low base. I think a population of 200 million people, all of them needing some kind of infrastructure, I think it's a good place to place your money.
Yeah. So, in terms of sustainable investing, ESG has become such a big thing. And I've always wondered how seriously Nigerian investors are really taking that. Because we hear everybody say, you need your environmental, your social governance. But are you really asking these questions and monitoring and reporting to your shareholders in a very deliberate way? And is it impacting your investment decision?
Yes, absolutely. We have an ESG policy in-house. We're also a public company, so it's also mandatory that we have that. We're not seeing a lot of requests as much as I'd like to see from investors, from business owners who are running ESG type businesses. On the lending side as well, because we also have a bank and we're lending, we're placing money also with people that have ESG impact as well. So it's very, very important to us. Sustainability is very key for VFD Group, and we'll continue to do all that we can to make sure that this particular space of investing.
Yeah, and I expect that space to grow, especially with sustainable banking principles and investing. Exactly. And FIM, it would be good to hear your take on this. But whilst you're also thinking about a response to that, is why is much of the capital still coming from Silicon Valley into your funds? And why are local investors not stepping up? Or perhaps they're stepping up and we just don't hear about these stories. What's your thought?
Yeah, I think it goes back to the history of the industry. Usually a fund manager will start with a small amount of capital or private funds, and they'll have some success, and then they'll raise a bigger fund, and then a bigger fund, and then a bigger fund. But because venture is so early in Africa, there aren't so many fund investors who have enough track record to raise these large funds. And so what we'll see often is for later stage companies that are raising, $20, $50 million in Series C in later stage, they have to go to Silicon Valley because those are the only pools of capital that are enough to satisfy those rounds. And those are also the types of deals that we hear about the most because it's the biggest tickets. And so I'll say there's a lot of local capital, but it's mostly concentrated at the early stage, and it's starting to filter into later rounds as well.
Yeah, for the ESG issue, are you getting more questions around gender composition of boards, or is it more around environmental impact assessments? On that ESG spectrum, what are some of the requirements that are playing up stronger for investors?
Yeah, I would say in the last 3 to 5 years, there's been a much higher emphasis on supporting female founders and for supporting gender equity in the workplace, which revolves around hiring decisions, harassment, and also the opportunities for success. I think the last 12 to 18 months, there's been a huge emphasis on climate. What types of businesses can actually have an impact on the climate story globally? And that's also indicated by so much capital going into that space. And so we're seeing that pressure from other investors, but also from the types of companies that are being successful and what spaces they're going into.
Yeah, very interesting. So Niyi, over the last few months, everyone has been talking about artificial intelligence and AI and deepfake technology. It's actually been driving me crazy because I'm like, this is the next big thing. And now we're hearing governments talking about putting in regulation to prevent the negative use of these technologies. Is this at all a factor in how you see businesses in terms of their ability to scale? Are you looking at artificial intelligence as an enabler of processes and technology within the businesses or projects you're investing in?
Absolutely. So this technology that's coming out now is game-changing. We do think that a lot of our businesses need to be thinking about it very actively. We're already engaging on the board with the management of those companies to see how they're using that technology. Data science and data analysis is going to transform business models, and every company just needs to be prepared. Otherwise, their lunch is going to be eaten.
Yeah, so we often ask the question about what investors are looking for. I have to ask you, what are founders looking for? And what is an investor red flag? As a founder, if an investor wants to come and invest in my startup, in my business, what are the red flags I should be looking for from a founder's perspective about the type of investor I would want to partner with? So I think the challenge that we've found is that when we see promoters or entrepreneurs that are just completely stubborn and unwilling to change their mind, even when the market is telling them something, could be a problem. There's a little bit of stubbornness that is required from founders and entrepreneurs, but at the same time, you just have to listen to the market and adjust your model as you go along. Yeah. I mean, would you agree? I mean, as a startup founder, red flags that would make you run from an investor, for instance?
Yeah, I would say the way that an investor approaches due diligence and the negotiation process is the same way they'll be as an investor. And so if they, are they doing what they say they will? Are they pulling, are they adding new clauses or adding new details that you didn't agree to? Are they responsive and supportive of you, of your team? I think there are early signs that founders can look for when they're engaging with investors to see how they'll act over time.
Yeah, so I think we have time for just very brief responses now. So I wanted to ask each of you for just one thing that businesses and founders can do to position their businesses for investment in 2023. And I'll start with you and I'll come to Niyi very briefly.
Yeah. I think founders need to focus on what is the path to profitability and building a sustainable business. It's not just about high growth, but it's what does this look like 3 years from now? And you need to have a clear answer and be able to articulate that to investors.
Yeah, thanks very much, Adenubi. And you, Niyi?
Yeah, same. Sustainability, profitability.
Yeah. Wow, great discussion. I wish we could continue, but I love the energy between you two. Adenubi, you're there in the Tech Hub. Thank you so much for joining us virtually. And Niyi Adenubi of VFD Group, thanks also for joining us in the studio.
Thank you.